Financial Statements Made Easy. Good morning. This is Commuting with Candace. And I was thinking about how many of my clients over the years, when they need a financial statement for something, they really don't understand what it is. So I want to make it really easy for you. So the first thing, you have two financial statements that are needed when you're going to get a mortgage, or you're going to get a loan, or you're going to do your taxes. One financial statement is either called an income statement or a profit and loss or a P&L. That's what you'll hear. I need your income statement. I need your P&L. I need your profit and loss. These are all the same statement, okay? And this is really simple way to think about it, okay? What an income statement does is that at the very top, it says, here's all the income that's come into my business, okay? So if you were using QuickBooks Online, you would have your business checking account hooked up, and every time a deposit went in, if it was from a sale, you would code it there. Now, if it was money from a loan or it was money that you put in the business, that's a whole different thing. But anyway, all your income comes in up there, okay? All the rest of it is all the money you spent. It's basically checking to see, do you have a net profit or a net loss? Is your business viable? If you really manage it, okay, like you have somebody doing your books and they're clean and you feel like you're not making any money, it's a great place to go. Because maybe, let's just say you sell a widget, okay? And you sell the widget for $10 and it cost you $2 to buy the widgets, okay? So now you've got $8 left. So the $10 is your income, the $2 is your cost of goods sold. And then you've got $8 to run your business. That's for marketing, advertising, shipping, insurance, telephone, internet, all the expenses that go into running a business, okay? So if you end up with a net loss or you're just running almost even, that's a great tool to go to say, okay, where am I going wrong? Is my product costing me too much money? Should I raise my price of my product? Well, if you buy it for $2, sell it for $10, that's 5 times the cost. Pretty good margin, okay? Pretty good margin. You got to feel good about that. So probably in that particular example, you're not going to be looking at your cost of goods sold or your income to say, hey, maybe this is off a little bit. You're going to be looking at all those other expenses. Where are you spending too much money? So the only way that you can do this in any organized way is that you have good, clean books. Let me talk about that, okay? So how do you have good, clean books? Today, we all do books inside of software. Most of software is hooked up to your bank accounts and credit card accounts for your business, and those things are flowing in. Every single time you have a transaction, it will flow in. The key here is putting it in the right bucket, okay? Putting it in the right bucket. I get so many profit and loss statements where people put, say you pay yourself, you transfer money to yourself, or you go to the ATM, or you pay some personal bills, and they've got that on their profit and loss. It's not where it belongs. That's a whole nother conversation. It does not belong there. When you pay yourself, it does not go in a bucket that goes to your profit and loss, okay? If you want to really see if your business is viable, you want to keep any extraneous spending or money for yourself off of that statement, okay? All right, so that's the profit and loss, income statement, P&L, okay? The second financial statement that a bank or a mortgage or when you do your taxes that you're gonna need is a balance sheet. So let's talk about that balance sheet for a minute. The IRS says you do not have to use a balance sheet or put any balance sheet information on your business tax return if you have less than $250,000 in assets. I would say most of my small businesses do not have $250,000 in assets. So what would that example of what that would consist of? So if you had a bank account that had $150,000 in there, okay, and then maybe you have some equipment that you bought for your business, it's on your fixed assets on your balance sheet, and that maybe is say another $50,000, okay? And then you've got a vehicle on there and that you haven't depreciated any of these things. Okay, and the vehicle was $100,000. Now you have to have a balance sheet for that tax return. But as long as you stay under $250,000, which most businesses do, because let's say you did buy a truck, we're going to depreciate it fully the first year, most likely. Okay, so though the value of those goes down on your asset section of your balance sheet. So what is a balance sheet made up of? Assets at the top, and that's a total. What are your total assets? And that has to equal your total liabilities. The remainder is your equity in the business, okay? Even if you don't have $250,000 in assets, many times when you're getting a loan or a line of credit or your mortgage, they want that balance sheet. So you do have to think about that balance sheet and try to keep it clean. So how do you keep it clean? At the very top is your assets, okay? So you're going to have your bank accounts, your savings accounts, at the very, very top, and you want to make sure they're always reconciled. So the number that is in there is correct. So, you know, you're keeping your QuickBooks up to date, or you have somebody that's keeping your QuickBooks up to date and you're keeping it reconciled. So that keeps that number really good. Okay. The next section would be, say you loaned somebody money and they owe it back to you. That would be a current asset. Okay. And then you have your fixed assets. That would be your trucks, your cars, your office equipment, your machinery to run your business. You can also have a building on there, okay? If it's a commercial building, you can also depreciate that. You could have land, but land is not depreciable, but it'll help boost up your assets. So if you have high assets and very low liabilities, it gives you a lot of equity in your business, and banks love to see that. They like to see you have equity, okay? All right, so now we've got our liability section. Liability is going to be, say you have payroll and you haven't paid your payroll taxes, that would be on your liability. If you have a truck loan, equipment loan, maybe you have a capital lease, and I'll do a video on capital leases, okay? Or you owe somebody money, okay? Or maybe the business loans you money, so the business owes it back. So these are all your liabilities. So now let's say your assets are $100,000 and your liabilities are $50,000. You have $50,000 in equity, retained earnings in your business. This is a beautiful thing, okay? That's a really healthy, strong balance sheet. Well, actually, you'd want to have less liabilities than that if you possibly could. The lower your liabilities, the stronger, and the higher your assets, of course, the stronger you are. So I hope this explains financial statements to you really simply. Most important, though, for micro, small businesses is just at least be able to read your P&L. Just know that everything that went in that income thing is actually income. Many times I get books and I'm like, oh, here's something from Wells Fargo deposited, and I find out, hey, that was loan proceeds. You don't want to be paying taxes on your loan proceeds, okay? So you want to keep that really clean. It's only income coming in from your clients. And then when you go down to your expenses, you know, just making sure that nothing is in there that doesn't belong, because you want to show a net profit, right? You do. That's the whole reason you're in business. So, and let me mention this. Sometimes I'll have people tell me, look, I just want to zero it out, or I want to have a loss every year because I don't want to pay taxes. Well, it's hard to get a loan when you have a zero net profit. It's hard to get a line of credit. It's hard to get a mortgage. You have to show income, okay? The other thing is the IRS will only allow you to take losses on your business for the first, 3 years in a row. I guess sometimes it's not just the first 3 years. 3 years in a row. After that, they just make you carry forward that loss, and you can't use it on your tax return that year, the 4th year or the 5th year, if it's over and over again. And they could even come to you and say, hey, is this a hobby, right? It's just depending on what your income is. So don't always want to have a zero net profit, right? Because we want to show strength to get our loans and mortgages and do those kinds of things. So I hope this helps you. I hope you have a beautiful day, and I'll talk to you soon.